Thanks for clicking. I'm Anthony, your host. It's Friday, Finance Fridays, and thanks for stopping by. On this week's episode, we're going to be talking about the monthly mortgage rate update. Where are rates today? Where were they just a few months ago? And having a conversation around what we suggest to some of our clients that might be approaching mortgage renewal. Maybe they're not approaching mortgage renewal for the next little while, what you should be doing, what you should be preparing for, as many Canadians are concerned with where rates are headed. We all see the headlines. We all see that, there's a lot of conversation around higher interest rates, recessionary fears. Many Canadians are wondering what to do with their finances. And obviously, first and foremost, if you're in a situation where you're finding yourself struggling, you should have a budget in place. Lots of tools, lots of resources to get a budget in place. I know many of you maybe do, but you'd be surprised how many clients we talk to that do not have a budget. They don't know what's coming in and what's going out every single month. They just do it. And when you start to break things down, you might start to see that, hey, I didn't know we had this reoccurring item that was coming out every single month. What is that? Or why do we have that? So very, very important as we get into challenging times. A lot of conversations around what I call analysis paralysis, which means the more we think about things, the less we end up doing. And that could be good and bad. Good in the sense that with higher interest rates, a lot of Canadians are putting off a lot of these larger purchases. Maybe they need a new car, but they're just repairing it. Maybe they have to get new appliances, but they're just going to work with what they have. Maybe they were going to do a home renovation project. They're putting it to the side burner because the carrying cost on that line of credit or the mortgage would be way too much. So all these things are putting many Canadians exactly where the Bank of Canada wants us to be. And that is thinking about our spending, pulling back on consumer spending to help get inflation back down to 2%. And this is the major question. But as Canadians begin to spend less and do less, well, that impacts businesses, that impacts obviously a lot of different other components. And when we talk about a recession, we talk on unemployment. While the businesses start to see that their revenues are coming down and they're forking out a lot more money for wages, you might be on the chopping block. Now, obviously, if you have a government job, you have something that's very secure, then you might be better off in the sense that you know that your job is secure. But if you're in the private sector and you were maybe the last person to get hired at that company, how secure is your job? And this is what's going through a lot of Canadians' minds right now is, I don't know what would happen if I lost my job, so I better start preparing for the worst. They say, hope for the best, plan for the worst. Fixed rate mortgages right now are on the move. So let's look at the rate review for October 2023 for rates effective October 5th. Obviously, with these bond yields moving around, these rates could change instantly. And it's very important if you're online looking at these rates that you pay very close attention to what you're being offered, if it's subject to change, when that actual ad may have been published, because there's a lot of bait and switches happening right now. Just be very cautious. All we tell our clients to do is that sometimes when it's too good to be true, it often is. If everybody's at one particular rate and these guys are offering this, what is being taken away from that rate? What are you not getting? Prepayment privileges? Are you locked into that mortgage with a bona fide sales clause? Obviously, a lot of questions that you should be asking about that rate. Don't always chase the rate, chase the product, because if interest rates do end up coming back down and you're locked in at a much higher rate and you want to get out, and even if the penalty makes sense, the savings make sense, if you can't do it, you're losing money, you're leaving a lot of money on the table, and it costs you thousands. So want to quickly go over what insured, conventional, and insurable means, just for maybe our viewers that are joining us for the first time. If you are, thanks for watching. Don't forget to subscribe, hit that notification bell, and if you're a returning viewer and you haven't subscribed to the channel, do us a favor, hit the subscribe button, hit that notification bell. So what I want to do now is go over insured mortgages very simply. It is buying a home with less than 20% down. It's insured because you have to pay a default insurance premium. Less money you put down, the higher the premium is, and the minimum in Canada is 5%. And that's a 25-year amortization max. You can go less, but 25 is the max, and the purchase price has to be sub $1 million. When you think about the insured and insurable products, well, there's switches and transfers that are in there, and these are basically very similar. The one major difference, or two major differences I should say, is that one, you have to be 20% or more down. Two, you are not paying the insurance premium on an insured or insurable switch or transfer if you have 20% or more down. The lender pays. And if you want to find out more as you're looking at some of these rates, you're saying, hey, what do these payments look like on my particular mortgage? What could happen in the future? Well, you can download our app in the description box below, and it gives you access to multiple tools and payment calculators that you can use to help make better financial choices when it comes to buying or refinancing or even renewing your mortgage. So moving over into conventional mortgages are basically as they sound. 30-year amortization, purchase price over $1 million. No insurance premium is added, but you have to consider you can refinance with this. If you don't have a line of credit, you want to move to a lender with a line of credit, you'd have to refinance. Maybe you're looking to pay out some debts, you need to refinance, and you can't do it with insured or insurable products. So you have to go conventional if you're looking to do that. So with that being said, let's dive right into these particular rates. 5-year insured mortgage as of October 5th, we were at 4.84% in June. Fast forward to October, we're now at 5.74%. And obviously that has been a big move. 5-year insured mortgages still relatively popular for some, not for all. Then we've introduced back into these lists is the 5-year insured variable rate mortgage. With that being said, prime was at 6.95% in June. It's now moved to 7.20%. So obviously we were at prime minus 1.15. Now we're hovering closer to the prime minus 90, 95, 1% mark. There are some lenders that might give that extra little bit, but there are some restrictions on it. But you're looking at 6.20% on the insured mortgage side. Then if you think about the 5-year conventional, you're at 5.19% in June. Obviously, those look like really good rates compared to where we are now, where we're at 6.54 for the same conventional mortgage. 5-year conventional variable rate mortgage was around 45 basis points off, was around 6.5% just a few months ago. Now we're sitting at around 6.8 with a discount of maybe 30 to 40 basis points off, and prime now being 7.20%. So remember that variable rate mortgage, very, very important conversation. 3-year insured mortgage, 5.24, now sitting at 6.24%. And we've seen a big movement in the 3 years. A lot of clients love the 3-year product because it gives them that good range. Not popular really now is the 1 and the 2 because they're so high rate. Those rates are in the 7 percentile. And then obviously the conventional 6.59. Then you have a 6-month insured product. That is something that's a little bit newer. Some lenders are offering this, but it is for insured purchases only and only for 6 months. You are eligible for renewal in 6 months, but obviously it's very low in regards to the rate, 5.50. Is that product going to be popular as interest rates continue to rise? A lot of people fearful about what's to come. I don't know, but it is a product that we haven't really sold, but it is something that some viewers are and some clients are actually talking about. So, we always present the pros and the cons. If you take that rate 6 months from now, if it's higher, is it better taking that product or, looking at those payment costs? But we just want to present that data to you now. If you are in a situation where your actual mortgage is approaching renewal in the next, let's say, 6 months or 5 months, do not wait to lock in a rate. Reach out to your mortgage professional and get yourself a pre-approval with a rate hold that's good for 120 days. Because if rates go up and you have that piece of paper with that security, you know that, hey, I'm at least protected in the event that rates go up. And that could be a difference of thousands and thousands of dollars, as that's something that we were doing with our clients just a few months ago. We were reaching out saying, hey, let's get you a hold on your mortgage. We know it's coming up for renewal. And by the time their mortgage was coming up for maturity, that rate was literally 60, 70 basis points higher that they were being offered by their bank. So we were able to win that business because we were just being proactive. So if you're an individual who wants to be proactive, reach out to a mortgage professional, lock something in. If you're an individual that is not approaching mortgage renewal in the next, let's say, year or so, and you're like, I'm out of time, I have lots of time, I should say, to get this done. My suggestion is that if interest rates continue to rise, obviously, we hope for the best, but we should plan for the worst. If the rates do end up going up, you do want to have a budget. Download the app in the description box below. Start running the numbers at these current rates and see exactly where you are with your existing payment, where you are with your new payment, and how much that difference is and what you should be budgeting or preparing for to spend potentially in the future, and make sure that your finances are covered. The last thing you want to do is be left in a situation where you can't afford it and it's coming up for renewal and now you're frantically looking to make adjustments or make moves at the 11th hour. Not a good idea. Try to get ahead with it. Do not leave it to the last minute. And if you know someone and you're watching this video that is in that situation, or someone that is that type of person maybe that leaves things to the last minute, maybe you want to share this video with them and help them by letting them know what they should be doing moving forward. But we'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead. We'll see you next week, and thanks again for stopping by.